Twitter fingers turning into recession fingers? With the recession possibly looming in our intimate future, you want a stable investment in something that won't kick the bucket when times are rough. Both of these stocks I'll talk about today are blue chip companies. They have survived multiple recessions and make billions of dollars in profits consistently. What makes them even more attractive is that they have both experienced some dips recently and are at super appealing valuations and starting yields. So, let's get into it. The first stock we're going to talk about today is Bank of America. Now, banks are affected more by interest rates than tariffs. But as the United States and China continue to impose tariffs on each other, President Trump is also putting pressure on the Fed to cut interest rates. Falling interest rates are great for stocks, but this means the interest margins the banks make money off of from lending out money shrink. Recessions could also mean people are less willing to borrow money and may struggle to repay their debts. Now that I've told you all the dark clouds hanging over Bank of America, let's dive into some good news. Bank of America is known as one of the big four banks in the US. Warren Buffett, the greatest investor of all time, just bought even more shares of Bank of America after its Q2 earnings report. This brings his total amount to $29 billion of Bank of America. That's about 10% of all the shares outstanding. Now, you shouldn't invest in companies just because Buffett does. After all, he does get some preferential dividend treatment us ordinary folk don't get. However, his long-lasting support should give you some confidence in Bank of America as a reliable company able to return value to its investors. Buffett has also been a longtime lover of bank stocks, owning some of Wells Fargo, Goldman Sachs, JP Morgan Chase, Bank of America, US Bancorp, and Bank of New York. Bank of America is also buying back $31 billion in share buyback program this year. That's right, $31 billion, or about 12% of all their shares outstanding, are going to be bought back. One of the reasons a company would do this is because they feel their stock is trading at an undervalued price. Bank of America has a forward ratio of 9. This company is also in much better hands than it was a decade ago, with its management team and CEO, who in the past 4 years have improved the company's efficiency ratio from 70% to 57%. Remember, a smaller number is better here. Their net income has also increased 17% annually, and earnings per share has more than doubled. Bank of America additionally has a reputation to be one of the premier banks among high net worth clients. Just this past earnings report, Bank of America reported a 4% increase in their loans and leases segment, while their consumer assets increased by 15%. Bank of America continues to move in line with technology, noting its strong active digital users rate growth increased and the amount of transactions happening digitally. This is better to monitor fraud, sell more promotional items online, and is a better convenience for the consumer. For those worried about their chances of being insolvent during the next recession, their debt-to-equity ratio is 0.96. A 1.5 ratio and below is typically considered reliable. For contrast, their ratio was 2.65 during the financial crisis over a decade ago. Hopefully by now, you guys have put down your pitchforks and are starting to see some light at the end of the tunnel for Bank of America. Before we move on to the second stock, please remember to like this video for the YouTube algorithm and subscribe to the channel to see more of my videos. These videos take hours to research and edit, so any feedback is appreciated. Our second stock may be just as controversial as the first, so be sure to first ask your financial advisor if your heart is healthy enough for Pfizer stock. Don't buy Pfizer if you take nitrates for chest pain, as it may cause an unsafe drop in blood pressure. Side effects include a cut in dividend in the near future. Call your financial advisor right away if your losses last longer than 4 days. Now, jokes aside, most of us know Pfizer is a drug company headquartered in New York. At around $200 billion market cap, Pfizer is a massive company and a part of the Dow Jones. Pfizer makes and holds patents to many different drugs, but its most popular ones include the cholesterol blocker Lipitor and this little blue pill, as well as a lot of other drugs. I can't pronounce a lot of them because I'm not a doctor, nor do I work in the medical field, but hey, they get a lot of sales. Now, Pfizer has been down 20% year to date because of a lot of merger news they kept announcing throughout the summer. They bought Array BioPharma for $11.4 billion and are merging its off-patent and generic drug units called Upjohn with Mylan. Upjohn and Mylan will merge to form a new pharmaceutical company. The company expects to generate between $19 billion to $20 billion in sales for 2020. The deal could also help Mylan contend with struggling generic drug sales in North America. Now, people see this as a chance for Pfizer to maybe cut its dividend, but we don't know that for sure, and the company that they are forming may not also pay enough dividends to cover the current one. Some good news for Pfizer is that they just announced that they're spending over $500 million on expanding a manufacturing facility in Sanford, North Carolina. There, it's responsible for making experimental gene therapies. Gene therapy has the potential to be a lucrative space in medicine. One of Pfizer's business partners, Spark, already has an approved gene therapy that treats a rare blindness disorder and costs $425,000 per an eye. Pharmaceutical companies are always going to be spending money on R&D to find the next best products, and that's just a part of the industry. The facility also makes a lot of Pfizer's vaccines, such as the one for pneumonia, Prevnar 13, which had $5.8 billion in sales last year. So we can see this company is constantly working on improving its research and development and acquiring other companies. But people don't buy this company for its growth. In fact, it's lagged behind the S&P 500 since 2001, which means you would have been better off buying an index fund than investing in Pfizer. People buy this company because it is a consistent blue chip company offering a nice consistent dividend, which, thanks to most of its recent dip, is now over 4% for the time being. Pfizer also has a pretty solid balance sheet. Both of these companies I mentioned are both cash cows, bringing in billions of dollars of revenue, as well as consistently beating earnings. But I can understand if I get some hate for these stock picks. Let me know in the comments what you think. Do you think now's the best time to buy these, or would you wait, or would you just never invest in them at all?